Can different beliefs actually make markets bubble up? It's a controversial question, but the answer is a fascinating yes. Let's dive into how the dispersion of beliefs, meaning all the different opinions traders have about a market, can fuel price movements, speculation, and sometimes even catastrophic bubbles. Picture this. Some traders believe a stock is going to the moon, so they start buying heavily. But at the same time, there's another group, equally passionate, thinking the stock is wildly overvalued. They begin selling. The result? Increased trading volume, as these opposing forces feed off one another. And in the chaos, prices can sometimes disconnect from reality. Here's the key insight. Dispersed beliefs create volatility, and volatility is where bubbles are born. When enough traders pile on to one side, say the optimists, all of a sudden, prices soar. But these inflated prices often aren't supported by the stock's actual value. It becomes a game of momentum and speculation rather than fundamentals. Let's take a real-world comparison. Ever hear of the dot-com bubble? It was driven largely by wildly optimistic beliefs about the future of tech companies. People poured money into stocks with no profits, sometimes even no sales, thinking they'd hit the jackpot. And when reality caught up, the pessimists were proven right. The bubble burst, wiping out trillions. But wait, doesn't this diversity of belief create balance? In theory, yes. When optimists and pessimists trade, the market price should reflect a fair balance of both sides. However, in practice, markets are emotional. Fear and greed can overpower rationale, leading to wild swings. So, how can you use this insight? The trick is to recognize when belief dispersion is approaching irrational extremes. Pay attention to sentiment indicators, trading volumes, and ridiculous price hikes that seem unsupported by fundamentals. These are signs that a bubble might be forming or ready to pop. Does this mean you should shy away? Not necessarily. Some traders successfully ride bubbles, making massive gains before the music stops. But it's a high-risk game. The better strategy for most traders is to avoid buying into the hype and instead position themselves to profit when reality hits. At its core, the dispersion of beliefs isn't good or bad, it's just part of how markets work. But trading smart means knowing when to ride the wave and when to step back. Tomorrow, we'll wrap up everything we've learned this week with actionable insights into how you can trade smarter by recognizing and managing these belief systems. Follow now to stay grounded while others chase the bubble. Join the crowd, a free weekly newsletter to help you trade with the professionals.